Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report. We're, of course, doing a live show. We've got some great information for you. We are taking your calls and your questions. Call the number on the bottom of the screen. You'll give your question to a studio producer, and then I'll answer the question for you. Or you can send me an email question to brianresny@reznywealth.com. You can also visit our website, reznywealth.com. We have offices not only in Naples but in Fort Myers, but we want to help you answer your important investing questions. More importantly, we want to make sure that you're not taken advantage of by so-called advisors, annuity salespeople, and brokers and Wall Street whose interests are far different than yours. Know when to sell. 3 indicators to watch is a question that I often get from a lot of my TV and radio listeners. And one of the things that happens to too many investors is you don't have an investment strategy, which includes risk management. So I want to discuss today 3 indicators you as an investor can watch to know, is the economy slowing down and is it time to sell equity-based investments in the stock market? Or is it time to hold on to those because maybe there's greener pasture ahead? My number 1 indicator is this. It's called the Golden Cross. This is a simple moving average indicator. It's when the 50-day moving average crosses below the 200-day moving average. This would be a sell signal, typically on a long-term trend. If the 50 days above the 200-day, that's typically in buy territory, and this shows positive trend of the equity markets, and usually a time that you want to continue in the equity markets. By the way, our 50-day moving average is currently above, so that trend is positive for the investment markets. Number 2, EPS, or earnings per share, earnings estimates of corporations. Are they going up or being guided up, or are they being guided down? This is another great indicator. If earnings start being guided down with corporations, that means things are starting to slow and we could be headed for a recession, meaning you'd want to sell equities. Right now, earnings estimates are actually slowly going up. This is again a positive. Unemployment. It's bullish when unemployment numbers are actually coming down, meaning unemployment is getting better. The unemployment rate is coming down. It's, of course, negative if unemployment rate is going up. Right now, we're about 6.5, 6.6 on the unemployment, and the overall trend is starting to come down. This, again, is another positive for the U.S. economy. So if I look at the 3 indicators, generally speaking, that we look at, amongst others, by the way, right now we are seeing favorable trends in the U.S. marketplace. I can't say that's everywhere around the world, but generally the U.S. marketplace has been one of the stronger areas, generally speaking. Emotions and lack of investment strategy, which include risk management, is detrimental to your portfolio. I'm going to repeat that. Emotions and a lack of investment strategy, which includes risk management or when to sell, is detrimental to your portfolio. I can't tell you how many investors come into our offices, whether it's Naples, Fort Myers, Coral Gables, or Boca Raton, and most investors do not have an investment strategy. Most investors falsely believe their broker or so-called advisors actually managing their money when they're not. So the bottom line is this. Do you have an investment strategy if you're self-managing your money? If you do not, and part of that strategy has to be, when do you sell any investment? What's your sell trigger in order to reduce risk in severe down markets? If you don't have an investment strategy, you certainly don't have risk management, and you're putting your portfolio at risk. I find 90% of investors falsely believe their broker is actually watching their investments. Again, this is not right. Too many investors falsely believe that their broker is actually managing their money, but they're not. In a brokerage account, you're responsible to manage your own money. Even though your broker may use a fancy title like advisor or financial planner, most investors, and I can tell you from experience managing money for 28 years, most investors, about 90+% of investors who come into our offices every day and hire my firm to manage their money, falsely believed that their brokerage account was a managed money account when it's not. So don't expect a call from your broker other than to sell you something new to refresh his commission, and unfortunately that works against you and your money. Your broker, so-called advisor, is not managing your money. Again, unless you're in what's called an advisory account with a registered investment advisory firm, under a registered investment advisor agreement, that would be managed money. So if you've been sold a brokerage account, an annuity, these again are not managed accounts. If you don't have an investment advisor agreement and working with a registered investment advisory firm, chances are your money's not being managed, but you falsely believe it is. Sandy in Naples, Florida. I'm 65 years old. My advisors recommended an American Equity Index annuity for my IRA. He says I can get $26,000 a year for life on my $500K with an income rider. What do you think? Sandy, I think that's a huge mistake. Do not buy an annuity. Annuities, first off, are sold to unsuspecting investors who don't read the fine print. I can tell you statistically, well over half of the calls that I receive on my radio show are from disgruntled investors who were sold an annuity from the attorney, the CPA firm, the insurance agent, or from some broker. At the end of the day, they might have a really good story to tell you, they might sound convincing, but again, annuities are sold, they're not bought. This equity index annuity that you're being pitched, do the math. They're going to give you $26,000 a year on your $500,000 for life. Sandy, at your age 65, it's going to take you almost 20 years to get your own money back. So what that means is this: if you live to age 85, all that insurance company did is pay you your own money. No return on your money. So again, these income riders, while they sound good in this income for life, is a great pitch by these annuity agents and salespeople. Remember, the agent, the person selling annuities, working under what's called suitability. They don't have a legal obligation to work in your best interest as a fee-only money manager or in a fiduciary capacity. I would read the fine print. Better yet, fire this person. Do not invest in this annuity. You'll make a huge mistake. And what I would suggest is call my office. Our number's at the bottom of the screen. You can make a consultation with our firm. Learn about real money management without the conflicts of annuity salespeople and the annuity sales job, as I call it. Get rid of those conflicts. Hire a real firm and only utilize a fee-only registered investment advisory firm like my firm. You can also go to my website, reznywealth.com, for more information about our firm. By the way, we have a special report for people who are being sold an annuity, who have bought an annuity. It's called Why Annuities Are Dangerous to Your Wealth and Retirement. The report is available on my website. In fact, I talk about these income riders and how toxic annuities in general are to you, the investor. Robert in Naples, Florida. I heard a question on your show about markups and markdowns on bonds. Can you explain? Great question, Robert. We get a lot of questions about bonds. People who buy bonds often don't really understand what they're paying to buy a bond. Now, the first thing is a markup and markdown is legal, meaning your broker or brokerage firm, it's legal for them to mark up and mark down the value of the bond when you buy or sell it. All this means is this: $100,000, you go to buy a $100,000 bond. Let's say that bond's trading at $98,000. Your broker can actually mark it up to 3%, let's say, and basically sell it to you for $101,000 without disclosing what that markup is or that they're actually doing this markup. Of course, 3% is a lot. Now, when you go to sell the bond, they do what's called a markdown. It's now trading at, let's say, $102,000, and they tell you they got $99,000. It's legal for your brokerage firm to basically work against you and your money by doing markup and markdowns. Investors truly don't understand the cost and the conflicts of working with a brokerage firm, a broker-dealer. And again, all the brokerage firms do these markup and markdowns, so don't think yours is exempt. What I would suggest you do is go to the FINRA.org website. That's FINRA, FINRA.org. Type in your brokerage firm name and type in markup and markdowns. You'll be shocked at how many of these firms have been fined thousands or hundreds of times maybe for excessive markup and markdowns on bond transactions against their clients. I've read reports from FINRA where they find firms, the major firms and small firms, that were marking their clients' bonds up excessively over 15%. That's robbery. You need to understand what it's really costing you to work with a broker, and those hidden costs that you don't see are coming against your real return and your money. Bob in Miami, Florida. Are dividends important in regards to the stock market? Bob, they sure are. In fact, if you look at dividends statistically speaking, they will make up between 30 to 40% of the return, the total return of many of the indexes, let's say the S&P 500. So if you didn't include the dividend on the S&P 500, your return actually could be 30 to 40% less. So dividend is important. Dividend is not the only determining factor when we look at investments, but it's an important factor. As an investor, dividends help soothe out some of the mild bumps in the road and do help investors who are looking for income, but more importantly, you want to look at what's called total return. Not how much your portfolio grows, but how much the income and growth or loss of that portfolio is combined together. Total return, again, can soothe out those bumps, and ultimately I feel total return can give the potential for a retiree to have a better chance for a more reasonable, consistent rate of return on their retirement portfolio. Sam in Naples, Florida. I'm 67. I bought a Midland Equity Index annuity and an income rider 3 years ago. I get $22K for life. It hasn't done well. Can I get out? Sam, that's a great question. Again, one of the things I talked about earlier in my show is well over half or close to half of the calls I get on my radio show are from disgruntled investors who were sold an annuity, whether it's these garbage equity index hybrid annuities, whether it's variable annuities. Most investors don't realize these are highly complex. They are riddled with fees. And the only reason insurance agents and brokers like to sell them is because of the commission they earn. These things are toxic to your retirement and they're toxic to your wealth. I would suggest you go to my website, download for free Why Annuities Are Dangerous to Your Wealth and Retirement. Okay? Read the report. It'll give you more details. But at the end of the day, one of the big problems with these annuities is they have huge surrender penalties that can last as long as 22 years, holding your money hostage or in prison. So at the end of the day, if you want to get your money out of this annuity, you might have to pay 10, 12, 15, 18% penalties to get all of your money out. Now, some of these annuities offer a small withdrawal each year, but again, why would you want to have your money locked up in prison for up to 22 years with surrender penalties that can be as high as 18% against your money? You would not want to. What you need to do is check out and find out how many years, again, you are into this annuity, how many years left is a surrender penalty, what's this annuity really costing you. I might suggest call my office for a consultation. My firm has reviewed hundreds, if not thousands, of annuities over 28 years. I can tell you we are experts at analyzing annuities. We can tell you exactly what you're in for, exactly what this thing is really costing you, and we could tell you, can you get out without getting hurt too bad? And so we can give you the quality information that sales agent who gave you the sales job on the annuity never told you. We'll tell you how to handle it and if in fact you can get out without getting too much damage to your retirement portfolio. I'm going to go take a short break. I'll be right back with your calls, your questions after this. Hello, I'm Brian Rezny, president of Rezny Wealth Management. Every single week I receive dozens of phone calls on my TV and radio show from disgruntled investors who were sold an annuity that didn't belong in their portfolio. Don't let your retirement be taken to the woodshed. Read my free report, Why Annuities Are Dangerous to Your Wealth and Retirement. Go to ReznyWealth.com right now. And we're back. We're taking your calls, your questions. Of course, you can call the number at the bottom of the screen. You can give your question to a studio producer. You can also send me an email question to Brian Rezny at ReznyWealth.com. Please visit my website. I know we always get a lot of calls and questions. I get a lot of email questions. We do have a live radio show, by the way, every Sunday through Southwest Florida. Go to my website, ReznyWealth.com, for times and station availability. We talk a lot about investing. Our goal as an investment advisory firm is to educate you, the investor, so you do not make bad investment decisions. You're not taken advantage of by Wall Street, so-called advisors, brokers, people's whose only interest is to sell you the highest commission, most inferior investments there are. You as an investor need somebody in your corner to help you make better decisions. That's what my TV and my radio show is all about. So again, send us your questions at brianrezny@reznywealth.com. Also visit our website, reznywealth.com. You'll get some great information, some reports that we've put together just for you, the investor, so you can read a little bit and learn how not to be taken advantage of by Wall Street and so-called advisors. Larry in Boca Raton, Florida. I own the PIMCO Total Return Fund, approximately 30% of my portfolio plus. Another 50% in other bond funds. 2013 was not a good year. I need income. What would you do? Larry, great question. We get a lot of calls from investors who overloaded the boat in bonds and bond mutual funds. The reason they did this is because they thought bonds are safe. Bonds can be as risky, depending on the time frame of interest rates, as the equity market. So a lot of investors remember that, hey, that their portfolio dropped in 2008. They lost some money. If you would have invested properly, you'd be at new high ground today. Unfortunately, most investors are actually not managing their own money correctly, nor do they actually have a money manager. So they're unfortunately falsely believing their broker or so-called advisor is managing their money. So when investors get nervous, they call the broker. The broker then sells them a new product. It happened to be a lot of mutual funds and bonds over the last 3-4 years. That's what we've seen with new clients that hire my firm every month. They overloaded the boat in bonds. Investors now are starting to lose money in bonds because when interest rates go up, bond values go down. That PIMCO fund is a good fund. The manager's a good manager. The problem is it's not the right area you want to be today. Interest rates, in my opinion, we could see 3 to 5 more years of interest rates slowly going up. Ultimately, if the economy keeps getting better, the Federal Reserve has basically stated that they're going to keep raising rates over time when appropriate. So if the economy gets better and rates keep going up, bond mutual fund values will go down. That means your total return could be negative. The longer the maturity of bonds in that portfolio, or the longer the maturity of bonds that you own, the more downside risk you have when rates go up. As a rule of thumb, if interest rates go up 1 percentage point, intermediate to long-term bonds or bond mutual funds could drop 10 to 12% in value. So I'll put this in simple terms. If you own $100,000 in a bond fund, it has an average 10-year maturity, and interest rates go up 1%, you could lose 10% of the value of that fund. Your $100,000 is now worth $90,000. This can also happen to the value of individual bonds. Most investors don't realize that rising interest rates are detrimental to bond values and your total return. So what I would suggest is this. First off, 80% in bond mutual funds is too much. If you do need income, look at floating rate type securities. These are really short-term floating rate security investments that act like bonds. The difference is they're very short-term in nature. So when rates go up, those values really don't go down much, if at all. And as rates go up, they can make a correspondingly higher rate because they're very short-term in duration, normally 90 days or less. So floating rate securities. Currently, in our income portions at Rezny Wealth Management for our clients, we do own helpings of income-oriented or floating rate security type investments because some of our clients need income, but we also want some of that risk protection against a rising interest rate environment. Remember, bonds are not the only investment that can go down when rates go up. REITs can go down, preferreds can go down. Other asset categories that are heavily tied to interest rates can also come down in a rising interest rate environment. Thomas in Naples, Florida. I'm working with an advisor. He recommended a non-publicly traded REIT I bought is Behringer Harvard REIT. It lost over half its value and income. Now he wants me to buy another. What would you do? Thomas, first off, fire that person. That person is basically a broker selling you, again, another toxic investment. Never, ever, ever buy a non-publicly traded REIT. Brokerage firms and brokers love to sell them because it pays huge commission. Did you know there are publicly traded REITs without gigantic commissions that rob your investment from the get-go? There's publicly traded REITs that are well diversified that you can buy through an ETF, exchange traded fund. Better diversification without, again, the lockup. Non-publicly traded means they're not traded. You can't get out, meaning if this thing goes south, like it has, you can't get out. That particular Behringer Harvard REIT, yes, basically dropped over half its value, and the dividend they paid, if you look at some of the research on that particular fund, dropped, I think, down to something like 1%. A lot of the income they were paying was actually from investor money. So what happens with a lot of these non-publicly traded REITs, number one, they may deploy leverage. Number two, they're not publicly traded, meaning you can't get out when you want to or should. Number three, often as much as 18% of your initial money when you buy one of these goes to underwriting and commissions. So that means almost 80 cents on the dollar is all that goes into the ground. You lose almost 20% of your original investment. This, again, is a mistake. Before you're sold another publicly traded REIT, call our firm, Rezny Wealth Management. We're a fee-only firm. I do not believe in non-publicly traded REITs for the reasons I cite. Sit down with us. We can review the rest of your portfolio and see if we can put together a better investment plan to help you meet your goals without the conflicts of what you're currently dealing with now, which is clearly a broker who wants to line his firm and his pocket the most. Again, avoid non-publicly traded REITs. Again, this is one of my toxic investments that I talk about. Huge markups, huge lockups. Avoid them. You don't need to buy one. Don't. Keith in Miami Lakes, Florida. When the momentum is in the stock market and it's favorable in an uptrend, do small and mid-cap stocks historically fare better than large-cap stocks? Keith, great question. Statistically, and again, this is not a guarantee to the future, but statistically, yes. When the market is favorable and we're in an uptrend, statistically speaking, often small and mid-cap sectors of the market outperform large cap like the S&P. It's not a guarantee to the future, but if you look at long-term trends, if you look at coming out of most recessions, if you look at most growth spurts in the U.S. economy on GDP, small and mid-cap have dramatically outperformed large cap. Couple reasons. First off, small and mid-cap companies can grow earnings and sales faster than gigantic companies that everybody invests in all the time. The other thing is small and mid-cap companies are often bought up by the large-cap companies in order to try and grow their earnings and revenue. So at the end of the day, small and mid-cap companies are very favorable. At Rezny Wealth Management, on our proprietary relative strength strategy that we run, we do own small and mid caps from time to time. I think that's a great opportunity for investors. So instead of just buying what you know, which is large cap S&P stocks or mutual funds, you might want to look at your portfolio and your investment strategy, and maybe small and mid cap might be better for your opportunity to actually grow. And by the way, small and mid cap companies also pay dividends just like large cap. The kicker, you might get better growth potential on the earnings, which could translate into higher stock prices for you, the investor. Craig in Marco Island, Florida. Where do you think interest rates are headed? You've been right, but I have not taken action, as my advisor tells me to stay in mostly bond mutual funds. Help. Craig, great question. I think rates firmly are going to keep going up as long as the economy continues to improve. Now, one of the things I want to talk about is interest rates are going to go straight up. No investment goes straight up, and no index or sector goes straight up or straight down. I call it the stair-step fashion. What you're going to see with interest rates is something like rates will move up kind of like 4 or 5 steps. They'll come down a step, step and a half. They'll kind of move back up more, come down a little more. That's called the stair-step fashion. Stocks act that way, real estate, oil, gold, almost all investments, if they're in a positive uptrend, and right now interest rates are, you're going to kind of see this uptrend over time. This is going to be detrimental, again, to bond investors. If you own too many bonds, it could be taken away from your total return or the value of your bonds. I think one of the worst areas to be invested right now is, again, in intermediate and long-term bonds. Those are going to be the most that are going to be hit and at risk as rates rise continually through the next cycle as the economy expands. Now, if the economy starts to falter and we start to get weak again, whether that's next month or 3 years from now, you'll probably see rates start to come down. That then would be a time to look at buying more intermediate and long-term bonds for rates coming down, because remember, when rates go down, values come up on bonds. The reverse happens in the interest rate cycle. So remember, rates go up, you're at risk as a bond investor. Make sure you understand what side of the fence your portfolio's on. Skip in Cape Coral, Florida. What do you think of variable annuities? My advisor is recommending me to move my IRA approximately $450K into a Pacific Life annuity. What are the negatives? There are a ton of negatives and no positives. So the bottom line is this, Skip. Again, your advisor is not an advisor at all. He's a broker with a fancy title. He's working under suitability. Pacific Life and all variable annuities, generally speaking, have very high expense ratios. The average, and by the way, we've reviewed hundreds, if not thousands, of annuities at my firm over the last 28 years. So don't think this one's any different. The average annuity that we have reviewed at our office has an average annualized expense ratio every year against your money between 3.5% and 4.5%. Some have been a little bit less and some have been a lot more. But at the end of the day, 3.5% to 4%, let's say the average is 4%. That's crazy. You could hire a fee-only money management firm, all cost in, easily, probably for less than 1.5% a year. That basically saves you 2.5% on your money, putting more money in your pocket. Annuities are riddled with fees and cost. They're going to rob your return and they're going to take away from your retirement income. Also, your IRA is already tax deferred, so why would you put in an annuity? Why would you buy an annuity with limited investment options? Why would you buy an annuity with excessive fees? Why would you buy an annuity that has big surrender penalties to get all of your money out? Don't do it. Your advisor wants to line his pocket with the next commission. That's not good for your retirement, and it's not good for your portfolio. Give my office a call. We'd love to talk with you about your investment needs. Folks, I am just about out of time. No emotional roller coaster for our clients. If you're finding that your portfolio is turning you into the emotional roller coaster, you're not sure what to do, you're not getting any real advice, call my firm. Our clients just want to enjoy their retirement. That's why they hire our firm every single day. They want us to manage their portfolio, work in a conflict-free environment, in a low-cost environment, and actually manage their portfolio. Call our office for a consultation. There is a difference, and we invite you to experience it. Please visit my website, ReznyWealth.com. You can subscribe for my blog and our newsletter for free. You can also download any of our reports. It's great reading and great education. We'll see you next week.